look, we're looking at fractional gains. Futures indicating a gain at the start of trading. S&P 500 and the NASDAQ both at record highs this morning, beginning a new day in uncharted territory. The NASDAQ closing above the 15,000 level for the first time. Investors are awaiting Federal Reserve Chair Jay Powell's speech at the Fed's Jackson Hole Symposium later this week. Yesterday, Dow Industrials up 30, but look at the NASDAQ up 77. Joining me right now is Cornerstone Macro's co-founder and chief economist, Nancy Lazar. Also joining the conversation all morning long this morning is Fox Business's Dagan McDowell and former Trump Deputy National Security Advisor and author of the book Revolution, Trump, Washington, and We the People, Katie McFarland, with us this morning. Great to see everybody this morning. Thank you so much for being here. Nancy, great to see you, and I've been very interested in so many of your reports recently. Let's get to first these markets and the reaction to an economy that has seen peak growth, and yet the market keeps hitting record highs. Tell me your assessment on the backdrop first, the macro story. Have we seen peak growth?
Well, we probably have seen peak growth. You can't grow nearly 10% forever, but that doesn't mean you slow very, very sharply. We have a very healthy economic backdrop. Corporate profits at a record high, core consumer income at a record high. As a result of the strength in profits, you're seeing a very, very robust job outlook. You basically have healthy consumer income, healthy consumer balance sheets, along with a very, very strong corporate sector. And so the private sector is now really driving growth. You've seen a very successful handoff because of that health from the policy side to the private sector now driving growth. Now, it doesn't mean there aren't bumps in the road. There, to be sure, are. The supply chain disruptions is affecting manufacturing. We saw that in some of the data this week. But over the past 18 months, it's really, really been key to stay focused on the longer-term outlook for the U.S. economy, which we think is being being driven by capital spending, which is creating jobs. Net, you're improving productivity, which at the end of the day is the key to a healthy economy. And so net, a few bumps near term in the month of August, but we think that's just a moderate temporary setback with growth still likely to surprise on the stronger side.
Yeah, let's go back to the consumer. You've written a lot about the consumer, just recently highlighting the back-to-school shopping and how it offsets the hit to the economy from the Delta variant. Talk about what you're seeing in terms of back-to-school and the strength of the consumer. I know that they've been saving a lot of money and really begin this new season with a strong balance sheet individually.
There's been concern with a pullback in fiscal stimulus. First, with the end of the stimulus paychecks we saw back this spring. Now, with the reduction in unemployment benefits, that we could see a hard stop on consumer spending. And we've just disagreed with that. The private sector is now driving core compensation. And so you have a record high in core income for the consumers. Second, as you mentioned, they haven't been able to spend all this stimulus over the past year. In addition, they've not been able to spend all the income that they've earned. So they have a tremendous amount of cash stashed away to the tune of about $4 trillion above where they were pre-COVID. That is a significant cushion for consumer spending, and you see them actually using that money for the back-to-school season. Our weekly foot traffic data that we look at for some of these larger retailers tied to back-to-school are seeing sharp increases in their foot traffic. At the end, there's probably a ton of pent-up demand. We didn't have a classic back-to-school season a year ago. And so the consumers do have the firepower to spend when they want to spend and when they can spend. We think within consumer spending, there is going to be some areas of weakness. You did see pull forward in a lot of sectors that benefited from the shutdown, to be sure, used cars, TVs, some sportswear. So you are going to see some weakness in certain sectors of consumer spending, but net, they're making that up in other areas, with the economy also still generally reopening as we go into the fall. Certain service sectors are going to benefit from that. Net, you will see slower consumption in 2022 than in 2021, but this year it's going to be around 10%. Next year, if you can, you'll be at least 3% with upside, given this cash that they have stashed away. So we're in the job market that will continue to support basic income.
So you really go into this period where the stimulus will be removed ultimately We think. We haven't heard about another unextended unemployment package going out, but the consumer is ready because of the pent-up savings that you're talking about going into that period where the stimulus goes away. Nancy, you've been spot on the China reporting as well. As you know, we have been zeroing in on this subject now for several years, trying also to warn investors about the risks here. Let's talk about China's heavy-handedness, as you write, in terms of what you want to say with regard to investing in Chinese companies, and what about American businesses that are going there to open up shop because they've been given licenses by the CCP to operate. Those are the financial services companies that we're going to hear more about what their life is like in this new world where they open up shop in China and expand businesses there.
So first, China has put in place policies now for almost a decade to moderate growth. So China has been in a slowing trend. And now what these new policies that they've really put in place, increased regulation since July 1st, since they have moved into their second century, will further increases the odds, indeed, you do see this more moderate growth. They're clearly increasing regulations, egregious regulations. They've moved toward common prosperity, which has been a long-term goal, which they've talked about for decades. It's just that we've kind of forgotten they were eventually going to do this, which is basically income redistribution through tax increases, donations, and literally a redistribution of income. Now, this isn't a hard stop. This is something that's going to take time to accomplish. It'll impact multinational companies in China, where they'll see slower profit growth. It'll impact property as they try to curb egregious property gains, and it'll impact, to be sure, consumer spending. Are you going to see a shift away from luxury goods back to more moderate areas or more normal parts of consumption, less luxury goods? Will you see a shift away from things like alcohol or even gambling, where you have a real cultural change for the common man, for the common good? These are their words, not my words. So China is still an investable country. You just have to recognize that it is a more risky country with these egregious regulations and very, very heavy hand on the part of Beijing. Again, 30 years ago, they talked about, well, the country can for now make a lot of money. Companies can make a lot of money, but over time, we're going to have to shift, and we're going to have to redistribute that income, which is now clearly where they're going to.
Yeah, and, I think it's important to recognize that 30 years ago was a different Communist Party than today. Xi Jinping is modeling himself after Mao Zedong, much more inward, much more communist nationalistic, as opposed to previous CCP leaders who wanted to at least entertain the idea of opening up, entertain the idea of moving a little to the middle to watch and see democracy and free markets take place and their impact. So it was a great warning that you gave investors a long time ago, and we are certainly with you on that story. Nancy, it's good to see you this morning. Thanks very much.
Thank you very much. Have a good day.